Do you want to keep more of your hard-earned money instead of handing it over in taxes? Smart tax strategies can save you a bundle. Tax deductions are not just a bunch of boring numbers. They're your ticket to significant savings. Understanding which expenses you can deduct can dramatically reduce your taxable income, leaving more money in your pocket. From everyday expenses to big-ticket purchases, we'll cover the essential deductions every small business owner needs to know. This isn't just about keeping more money today, it's about setting up your business for long-term success. Don't forget to hit the like button, subscribe, and turn on notifications so you never miss out on valuable tips like these. Let's get started. What are tax deductions and how do they reduce your taxable income? Tax deductions are specific expenses that businesses can subtract from their total income before calculating how much tax they owe. By reducing your total income, these deductions can lower your tax bill. For example, if your business earns $100,000 and you have $30,000 in deductions, you'll only be taxed on $70,000 instead of the full amount. Why are tax deductions so important for small businesses? Tax deductions are vital for small businesses because they help reduce the overall tax burden, allowing business owners to save money. This saved money can be reinvested into the business to help it grow, improve its operations, or even to increase the owner's salary. Essentially, understanding and utilizing these deductions can be a game changer for small businesses by making them more financially stable and competitive. What are some of the common types of tax deductions? There are many types of expenses that can qualify as tax deductions, but they generally fall into two categories: operating expenses and capital expenditures. Number 1, operating expenses. These are the costs for the day-to-day operations of your business. This includes rent for office space, salaries paid to employees, money spent on marketing, and utility bills. These expenses can usually be deducted in the year they are incurred. And number 2 is capital expenditures. These are usually larger expenses that benefit your business over a longer period. This includes buying machinery, vehicles, or property. Unlike operating expenses, capital expenditures are not fully deducted in the year they are made. Instead, they are capitalized and depreciated over several years, according to the rules set by the IRS. Let us move on to the home office deduction and how you might qualify for it. The home office deduction allows you to deduct expenses for using a part of your home exclusively for business activities. To qualify, you must use this area regularly and only for your business. The deduction can be calculated in two ways: the simplified option, which gives a standard deduction per square foot of your home used for business, or the regular method, which involves calculating the actual expenses of your home office area, like rent and utilities. How can you deduct vehicle expenses? If you use a vehicle for your business, you can choose to deduct your expenses using the standard mileage rate or by calculating the actual expenses. The standard mileage rate simplifies record keeping by applying a fixed rate per mile driven for business purposes. Alternatively, with actual expenses, you can deduct the real costs of operating the vehicle for business, such as gas, repairs, and insurance. Whichever method you choose, keeping detailed records and receipts is essential. What counts as deductible supplies and equipment? Small businesses can deduct the cost of supplies and equipment necessary for operation. This includes everyday office supplies like paper and ink, as well as bigger items like computers and furniture. For larger purchases, you may need to decide between deducting the full cost all at once, immediate expense deductions, or spreading the cost over several years as in the case of depreciation. The choice depends on the item's expected use time and your financial strategy. Are employee salaries and benefits deductible? Yes, the salaries and benefits you pay to employees are fully deductible business expenses. This includes direct wages, healthcare plans, and contributions to retirement plans. These deductions not only lower your taxable income, but also enhance your company's appeal as a good place to work by offering valuable benefits to your team. Can you deduct rent and utilities for your business? If you rent space for your business, the rent you pay is fully deductible. This includes any office, storefront, or other facility that is used for business purposes. Additionally, Utilities like electricity, water, and internet service that are necessary for your business operations are also deductible. This means that the costs associated with maintaining your business space can significantly lower your taxable income. What about deductions for professional services? You can deduct fees paid for professional services that are necessary for running your business. This includes payments made to lawyers, accountants, consultants, and other professionals who provide services that help your business operate legally and efficiently. These deductions are beneficial because they not only reduce your taxable income, but also allow you to afford expert advice and support without a heavy financial burden. Are marketing and advertising costs deductible? Yes, expenses incurred from marketing and advertising are fully deductible. This includes costs related to promoting your business like online ads, print media, billboards, and promotional events. Investing in marketing is crucial for attracting new customers and growing your business, and being able to deduct these expenses makes it easier to allocate resources towards effective advertising strategies. Can you deduct education and training expenses? Yes, you can deduct education and training expenses that are necessary for improving skills or expertise relevant to your business. This includes workshops, courses, seminars, and books that help you or your employees perform better. The key is that the education must be related to your current business, not for preparing for a different career. When are travel expenses deductible? Travel expenses related to your business are deductible when you travel away from your regular business location. This can include costs for transportation, lodging, and meals during business trips. To qualify, the travel must be primarily for business purposes. Keeping detailed records and receipts for these expenses is crucial for proving their necessity in case of an audit. What types of insurance premiums can you deduct? You can deduct premiums paid for various types of business insurance. This includes liability insurance, which protects against claims of negligence or harm to others; property insurance, which covers your business property in case of damage or loss; and even health insurance premiums if you provide health coverage for your employees. These deductions help lower your business's overall cost of risk management. What are the best practices for record keeping and documentation? To ensure you can claim all eligible deductions, keep detailed and organized records of all business transactions. This includes saving receipts, invoices, bank statements, and logs for mileage if you claim vehicle expenses. Using software or apps to track expenses can also help keep everything in order for easy access during tax season or in case of an audit. How can you legitimately maximize your deductions? To maximize your deductions without crossing legal lines, make sure every deduction is legitimate and properly documented. Understand the tax laws related to your business deductions or consult with a tax professional. Take advantage of all applicable deductions, such as home office expenses, vehicle costs, and depreciation, and always keep an eye out for changes in tax regulations that may affect what you can claim. What are some of the red flags that might trigger an IRS audit, and how can you avoid them? Certain actions can raise red flags with the IRS and increase your chances of an audit. These include rounding up numbers on your tax return, claiming excessive deductions that seem disproportionate to your income, and reporting significant changes in income without clear reasons. To avoid these triggers, be as accurate as possible in your financial reporting, avoid making large, unusual deductions without solid documentation, and ensure consistency in your filing. Why is it important to stay updated with tax law changes? Tax laws can change frequently, and staying informed is crucial to make sure you're taking advantage of all possible deductions and complying with new rules. Changes in tax laws might affect how much you can deduct and what kinds of expenses are eligible, directly impacting your business's finances. How can recent changes impact small business deductions? Recent changes in tax laws can either broaden or restrict the deductions you can claim. For instance, new deductions might be introduced that could benefit your business, or existing deductions might be modified or phased out. Understanding these changes is essential to plan your finances and potentially save money on taxes. Thank you for watching our deep dive into key tax deductions for small businesses. Remember, understanding and applying these deductions can significantly impact your business's financial health. Don't leave money on the table. Make the most of every deduction you're entitled to. If you found this information helpful, please like this video, subscribe to our channel, and share this video with other small business owners who could benefit from these tips. Have questions or want more content like this? Drop a comment below. Stay savvy, and here's to your business success.